Hello and welcome to interest.co.nz. I'm Gareth Vaughan with our monthly Never a Dull Moment currencies report, joined by Dan Bell, Director of Sales at HiFX, as usual. Good to see you, Dan.
Yeah, you too, Gareth.
Look, we'll kick off with Graeme Wheeler. Obviously, we've had a speech from him this morning. He has talked about more cuts to the official cash rate. He's also raised concerns about the housing market, which we know all about that. And he's talked about seeing inflation settling at 2% in the medium term, which is sort of interesting too. What's the market making of his speech, and what sort of impact are we going to see on the dollar from this?
Yeah, so Reserve Bank Governor Graeme Wheeler was speaking this morning. It was, and the theme of his comments was really that there is further room for monetary policy easing. Our cash rate is at 2.75% at the moment, and obviously the market is expecting that to be cut to at least 2.5% over the next 3 to 6 months. The timing of that, I think, as the Governor said this morning, will depend on how the housing market plays out, and obviously that's going to be an ongoing concern for the Reserve Bank as house prices in Auckland and across the country seem to continue to go higher. So, balancing weaker global commodity prices and what actually appears to be a bit of slower global growth at the moment. I think the Governor wants to also leave some firepower in monetary policy. So if we were to cut rates too far, then the effectiveness of monetary policy going forward, if we were to enter into a recession, would be a little bit muted.
So we get our next OCR review on October the 29th, so not too far away now. Yep. What do you think we'll see then?
I think he's probably going to stay on hold at the October meeting, but it's still going to be probably about a 30% chance of a rate cut. So there's still an easing bias there, but I don't think he's necessarily going to do anything. If you look across to Australia, the Reserve Bank of Australia has been on hold for the last few months as well, and it feels like at the moment the New Zealand economy is in a little bit of a stabilisation phase. We've seen milk prices have obviously recovered from their lows, certainly as reflected in the Fonterra global dairy trade. They're actually up a good sort of 40-50% from those lows that we had earlier in the year. Business confidence and consumer confidence, again, not amazing, but certainly at decent levels. So it feels like we're in a period of stabilisation for the New Zealand economy, and I think that will be reflected in the Governor's decision in a couple of weeks when he leaves the cash rate unchanged at 2.75.
Okay. Internationally, US Fed obviously is under enormous scrutiny. We were expecting them to begin increasing interest rates this year. It hasn't happened yet. They're sort of running out of time if they're going to do it. Obviously, they've had official interest rates there zero for years now. Are they going to do it? They've got 2 meetings left.
They do have 2 meetings left, the 28th of October and then the 16th of December. So the October meeting is no. They're not going to raise interest rates in October. That's pretty much the market is pretty much certain of that. December though is still on. The last Fed meeting, they've obviously referenced some of the global uncertainty, particularly what's happening in China as impacting their decision. Obviously, the US economy has been performing better over the last couple of years, and continues to show signs of improvement. But then you get a little bit of patchy data like we had last month with the US employment numbers coming in a little bit weaker than expected, and suddenly everyone's questioning whether or not the Fed will indeed start raising interest rates. Now, if you actually go back to the earlier on in the year, Fed policymakers were pretty certain that they would start raising interest rates this year. And so there is a little bit of, credibility on the line with the messaging and communication that's coming out from the Fed, because they pretty much said that rates would go higher this year, and suddenly we're getting some of the Fed policymakers contradicting each other. So you get the speech, there's various voting members on the committee, and from time to time you get a speech from one within the same day that is completely at odds with each other. One saying that we probably won't see rate hikes until March 2016, and another one saying that they should have raised rates already. So it's everyone is talking about the Fed and financial markets and watching what they do, and that's a key reason why the New Zealand dollar has in fact rallied from recent lows around 62 up to a high in the last 48 hours of around 67.40, which is an 8% rally in a pretty short period of time. Because the market is starting to push out the potential for the Fed to start raising interest rates, which has an impact on obviously global sentiment, investor sentiment, and the underlying strength that we've seen in the US dollar this year.
So you think that that Christmas hike could still be on from the Fed? What are the odds, do you think?
Oh, look, it's probably about 50-50 at the moment. I think if you look at, I don't know what the interest rate market is pricing in today, but looking at a lot of the analysts out there, it's probably about 50-50. And, right here, right now, the reality is, the interest rates in the US are still at 0 to 0.25, so they're still extremely low. All the Fed will be doing is taking interest rates up by 25 basis points. And I think what they should be trying to do is actually give themselves a little bit of capacity to use monetary policy if in fact they do need to use it next year or the year after if they enter a recession. Otherwise they're going to have to go back to quantitative easing and printing money, which isn't necessarily ideal.
No, probably not where they want to go again. Now, China's obviously very important as well in the global picture. We've seen some weak import data out of China. So I guess suggestion is that maybe that economy is slowing. This has knocked the currencies around overnight. What's the outlook there, and how concerning should that be for New Zealand, obviously given China's a key trade partner for us?
Yeah, so China, imports in China yesterday down 17% for September year on year. So obviously China's imports are going to have a big impact on New Zealand and Australia because we export. They are our largest commodity export market now. Likewise for Australia. So the message out of China is that we know they are trying to transition their economy from this infrastructure and driven economy to a more services orientated economy, trying to stimulate domestic demand rather than stimulating these growth in apartments and construction, which has favoured New Zealand and Australia for the last 5 to 10 years. So, and China's having a big impact on the commodity cycle. There's no doubt about it. You look across the board. I mean, commodities have been hugely impacted by China, and so I think we're going to see a continuation of weakness in commodity prices driven by this underlying structural change, which is slowly occurring in the Chinese economy, but it's not going to happen overnight. China isn't going to suddenly become a service-orientated economy. It's going to take a while, but the Chinese government is still trying to maintain the sort of 7% growth path, but it's going to be tricky for them to continue to do that.
Now, with all of this going on around the world, obviously the New Zealand dollar has been volatile. Obviously, you mentioned down around 62 US cents recently. Now we're back up 66 with 67 yesterday. Where do you see it tracking through the rest of 2015?
Yeah, I mean, 2015 is we've only got 2.5 months left in the year, and to be honest, I think most of the damage for the New Zealand dollar has kind of been done. I think we're probably at a time, as I said before, we're stabilising against a lot of the major currencies. I mean, if you look at the New Zealand dollar versus the US year to date, we're down even at current levels, about 15%. Against the Aussie dollar, we're actually around unchanged against the Aussie dollar, slightly higher. Against the likes of the euro, we're down. Against the pound, we're still down over 10%. Against the yen, we're down over 6%. So Yeah, look, the New Zealand dollar is still much lower than when we started the year, but I think we are in for a period of stabilisation. But overall, we continue to see the New Zealand dollar weakening over the next 6 months, 6 to 12 months, as this commodity cycle continues to unwind. And monetary policy continues to come in to support that, which means lower interest rates in New Zealand, and to be honest, probably lower interest rates in Australia next year. Some analysts calling the cash rate in Australia down to 1.5%. I think if we see that, the Reserve Bank will be under pressure to see our cash rate down as low as 2%, which will be the lowest that we've pretty much ever been. So, I think low rates are here to stay. Looking offshore, I mean, even if the Fed do raise interest rates by 25 basis points, their cash rate if the Fed funds rate is still under 1%. In the UK, inflation is pretty much non-existent. Again, the inflation reading this week coming in negative, so interest rates in the UK don't look like they're moving. Japan is still printing money. Europe is still printing money. So in this context, the new normal is lower rates for longer, and I think New Zealand and Australia are playing a bit of catch up with the rest of the world in terms of where our cash rate and our interest rates need to be over the next 6 to 12 months.
Well, thanks for that, Dan. That's Dan Bell, Director of Sales at HiFX, and I'm Gareth Vaughan at interest.co.nz with our monthly Never a Dull Moment currencies report.